everybody, for the Lance Roberts Show podcast right here at realinvestmentadvice.com. Michael Lebowitz, CFA, Skyping in with us today from his hometown and hidden in his bunker today after the last few days of sell-off. And Richard Rosso, certified financial planner, also hanging out in the studio today. Just a second ago in the first market, we're kind of really going through the market where we are today. After the bell right now, we're seeing Netflix reporting they're beating their estimates. And, of course, not surprising they're beating. Estimates have really been brought down a lot for the company. We'll kind of weed through these estimates over the next 24 hours, see how this works out tomorrow. The big look there is going to be on their subscriber growth in particular. But, again, along with the market action today, you're seeing movement back into a lot of these really beaten down technology stocks. Netflix is up about $61 after the bell right now. Mike, what did you think about the market today? What was your opinion of the move?
It was a pretty impressive rally. Prior rallies we kept seeing getting capped, so to speak, as sellers would come in. But today there wasn't nearly as much of that, telling us that this may have been a short covering rally. But it was definitely pretty impressive. And again, this is all part of it's telling a story for us. So let's see where this path goes. But I have my suspicions that around the 2850 area is where we're going to start feeling much heavier resistance, and deciding on whether we can break through that level or not will help us go forward.
Yeah, and I think that's a key point, too, here is that, first of all, this is a one-day rally. Let's not get all too excited about the fact that this is the return back to the bull market. We're going to go to all-time highs. And look, that's certainly a possibility that we could rally right back up to all-time highs. We could put this right behind us, be no big deal. But when we're looking at this rally, understand that a lot of people got trapped in the sell-off. It happened very quickly. And just as it got sold off, people started really worrying about this. And on a rally, we're likely to see some of these people that were trapped in the markets come back in to sell. And so I agree with you that probably somewhere between this 28.25, 28.50 level, we're going to run into a lot of resistance on both Fibonacci retracement levels as well as previous resistance levels that are going to be opportunistic selling points for a lot of people. So we could see the market kind of struggle here once we get kind of move a little bit higher. I don't disagree with that.
Lance, can I also, there's something else that I think is very important. Mm-hmm. When we talk about breaking support levels, breaking moving averages, and how sensitive should one be? So if we break a very important moving average by 0.25%, should we immediately do something to our portfolio? And first of all, there's no hard and fast rule, whether it's just getting below a support level or getting below by 2% or 5%. But what I would say, your sensitivity to technical levels has a lot to do with fundamental valuations. So we've talked and written very, numerous times about how valuations are extended right now. There are a lot of ways of calculating valuations, but there's at least a half dozen that are on par with 1999 and 1929. And we know what happened after both of those years, and it was not pretty for investors. So given that we're at levels that are very risky, but fundamentals on their own do not tell you that the market's going to collapse. But what it does tell you is that the likelihood of poor returns going forward is high. That valuation level should help on the sensitivity to support levels. Mm-hmm. So if valuations were very cheap today, we would not care as much if we broke through a support level by 0.5%, 0.25%. Today, however, because there's a much greater risk of downside follow-through, where we're talking 20, 30, 50%, possibly more over a longer term, we do want to be more sensitive. And that may mean that some investors make some mistakes and they sell and then they get back in. But we need to be much more mindful today than at various other times in the market's history.
There you go. Richard, what do you think?
Well, I think you both bring this up, but to me, it's this transition away from cheap money to fundamentals. It's from the period of time where we're on the horse chasing the train and we're going to jump on it to actual fundamentals will start to matter. And that, to me, seems like that's going to be a real volatile road. So and Mike said there's no easy answer, right? There's no easy answer on what to do when you break support levels. But as you always both mentioned, and Lance, I think you sort of predicted this a couple of days ago, that we would get this oversold bounce, that this is not surprising. I guess it's where it goes, right? Where we end up because of all the levels of resistance that we have.
Right.
That we have to be careful. And what I'm worried about is for a lot of individual investors is they're going to get whipsawed tremendously, and they're going to sell out, get frustrated, get back in, and they're going to churn their portfolios quite a bit through this period because they're just not used to the volatility. So what would you both say to maybe even people who are doing this on their own, or how to keep a level head through this period as I think we go from the detox out of cheap money and liquidity to when fundamentals matter again?
Well, and look, we kind of talked about this earlier, and this is, again, when you talk about technical analysis, look, we write an article every Tuesday. It's our Technically Speaking Tuesday. We write this article every weekend. We write an article and we talk about the technicals of the markets, and it's always interesting. These articles get picked up all around, by publications all across the country, and we'll go and we'll read the comments, and the majority of the comments are simply, technical analysis doesn't work. You can't time the market. And this is the big misnomer about technical analysis and market timing, these type of things, is we're not recommending that you be all in or all out of the market. That's not what managing a portfolio is about. Managing a portfolio is about managing the risk. So when things aren't working, and they aren't working for one reason or another, maybe it's fundamentals, maybe the market just doesn't like it, there is that issue. You need to know when to sell that. The same thing goes with when you're going to buy something. Look, I could have bought Amazon, 5, 6, 7 weeks ago, and today I'd be losing a good amount of money in it because I simply just bought it at the wrong time. But when it was at its peak, it was extremely overbought. It was extremely extended from its long-term moving average, and there was going to be a pullback in the price of Amazon. You've now got that. Netflix was the same way. Facebook, all these stocks were extremely extended before they had these corrections. Now, if you're a diehard Amazon or an Apple or a Google fan, or you believe that Facebook is not going to become the next MySpace like I do, then this is the time to buy it, because you've had the correction, they're oversold, and you've got a better risk-reward opportunity today than you did previously. So for us, this is why we don't care about what happens in the middle of the week. A lot of people email me and say, well, you broke your moving average yesterday. You need to sell now. Yep. And I'm like, no, that's not the way this works. This is when we break those support levels, it's telling us something is going on. We want to be aware of that. But it's where we finish the week. By stripping out Tuesday, Wednesday, Thursday of every week, getting rid of that volatility, on Friday, when the markets close, we can look at weekly data, smooth out the volatility, and make a much better assessment about where markets are headed, what the trends look like for individual securities, what the real risks are, and whether or not we actually need to take action or not. That's how you properly employ technical analysis with portfolio management. It's not really fundamentals versus technical analysis. Fundamentals tell us what we want to buy. It tells us what the value is. Technicals simply tell us when to buy it and when to sell it. Mike, your point?
Right. No, that's a great point, Lance. And trying to use them in combination is hard, but it's a very worthwhile exercise. You, I think it was last Thursday or Friday, after one of those big down days, you made a great point. Something to the effect that if the market moves are keeping you up at night and making you anxious and worrying you, then you own too much stocks.
Yep.
And even though the market's up today and you may feel a little better, if you had those feelings, you probably own too much of a percentage of your wealth is in stocks. So you know that's just something to think about, that the market can move violently within a week, like Lance was saying. But if you don't have the stomach to last from Friday to Friday, then you own too many stocks.
And this bounce could be your opportunity to lighten up. It doesn't mean to get out of the market completely. It just gives.
That's right.
How many people have probably never rebalanced? What always dismays me about 401ks is people put money in and it goes into some sort of black hole and they never look at it again and they don't rebalance. Or I've got a 22,075 target fund that's 100% in equities and they don't realize how that works. So financial literacy is sort of a disgrace around here. So if you do see this happening, as to your point is, and you feel good or you feel bad about markets, depending on how they move, that tells me that you are too overly invested in equities. And Mike just brought up this point. Who knows what higher valuations do to the market? They're horrible. It's a horrible short-term indicator, but what it does help us understand is that future returns are maybe marginal at best for the risk that you take. So if you get a few more days, Netflix probably has just set the tone nicely, as well as IBM, for tomorrow. UAL, there's some really good earnings coming out, at least compared to estimates, which is always that game, right?
Well,
Lance?
I was just about to say something.
But it's the game.
IBM is always a great case study for playing the tax game. IBM consistently beats revenues, beats earnings, even though on declining revenues, because they consistently get a lower tax rate. And because a lot of these estimates that we're seeing coming in right now, yes, these companies are beating estimates, but it's on tax cuts, and basically that's still an effect that we have going in. And then, of course, we've had a massive amount of share buybacks. And then, of course, what we've seen coming into this earnings season and this quarter is already a reduction in those estimates. If we went back to just the last quarter and used the estimates that were on these companies then, Netflix just missed.
Yeah.
So
that's absolutely true.
Netflix
just missed.
But see, we don't look at it that way.
No.
We simply look at, and also look for, make sure in these earnings, make sure to look for currency conversion issues. A lot of these companies are beating earnings. We've had a stronger dollar, and if they handled their currency transition well, that's added a lot to the earnings bottom line as well. Mike?
And I would also say look for non-GAAP type disclosures about tariffs, trade actions, like you said, currency actions, because while they may try to classify them as non-GAAP, they are real gains or losses.
Yeah, and don't forget, every quarter we have a massive amount of one-time charge-offs that occur every quarter. So it's always, and to Mike's point, it's always these one-time charges, these non-GAAP items. Pay attention to those, because that really tells you what the real strength of these earnings actually look like. Now, the market doesn't pay attention to them initially,
right?
But it eventually catches up.
And all at once.
Yeah. One thing that you brought up, Richard, I did want to touch on real quick, was about rebalancing. One of the issues about rebalancing that it goes unnoticed is that people say, well, you need to rebalance your portfolio. What that means is you basically sell your winners to buy your losers. That's what rebalancing means. The best way to rebalance your portfolio in this particular environment that we're talking about, we're particularly in our portfolio management, we're going to do a rebalancing here very shortly. But as I said earlier in the podcast, is that small caps and mid caps have now broken trend. Now, they have actually done something that the major market hasn't, the S&P hasn't, is that they've actually broken their trend. They have actually changed the direction and tone of their market. So we want to be reducing that risk in our portfolio. So when we rebalance, we trim back things that aren't working, or we sell things that aren't working. We add money to things that are working, or we simply just hold cash until we know where to put money to work. Remember, as investors, our job is to invest money where there's opportunity, where reward outweighs the risk. And if you don't have something today, right this minute, that's okay. As Mike said yesterday on the podcast, cash pays something now. Cash is an alternative, and you can hold cash now, waiting for the right opportunity to come along. Richard?
Well, years ago, it was always, the adage was, and I still think it holds true, you guys can add color to that, but it's troublesome when small and mid-cap stocks break down. Isn't that giving you a bigger message about what's going on in markets?
Right.
Versus what's happening with large cap? And when did this divergence in mid and small cap, which we've noticed, how long has that been now? A month? A little bit longer, that we started to see mid and small cap collapse, or start to collapse here compared to large cap? And it's always large cap growth. So we're cordoned into this one little style box now of asset class, and nothing else is performing. And that's, yes, we see some violent sector rotations into staples and other things, but for the most part, there's less and less companies, it seems to me, that participate. And when I don't see small and mid caps performing, that's sort of troublesome. I would think that still holds, right?
Yeah, absolutely. And I'm going to let Mike's got a comment on this as well. But one thing that is important to note about this, and today's rally is really key to this. Small cap and mid cap did rally today, but it didn't rally nearly as much as large cap. And what that tells you is that hedge funds, pension funds, mutual funds, etc., they are going into the most highly liquid names in the markets, things that have a lot of depth and a lot of breadth. The Apples, the Googles, the Amazons. There's millions and millions of shares outstanding. So I can move large amounts of money into those stocks and back out again without affecting price. If I try to do that with a small or a mid-cap stock, I can wind up effectively largely moving that stock or that index to a greater degree than I should. So for a lot of managers today, we saw this was really money moving into highly liquid names because, as Mike said earlier, this really wasn't a hugely convicted rally today. Yes, it was a big rally today, but the volume really didn't suggest that the bottom that we just saw was the bottom, and that this is simply just a bounce within a corrective process that we remain in. Mike?
Yeah, I guess another way to say that is they're showing signs that they're renting and not buying.
That's a good point.
There's an old saying that goes, volatility begets volatility. And it wouldn't surprise me if we saw a down 50-day tomorrow or an up 50-day. So we should expect much larger price changes over the coming weeks. We saw this in January and throughout February, even March and April. And my guess is that now that we've had another big dose of volatility hit the markets, that we're going to see big changes in both directions.
Right.
So try not to get fooled either way on big down days or big up days. Just keep an eye on the trend and what levels of support and resistance are holding or breaking.
Yeah. Don't you need to keep track of where yields are? I think if yields, even though we're at 3.16 or 5 on the 10-year, which is pulled back from exactly where you said they would, Lance.
Right.
I think they hit a peak at 3.25, and you had pointed out that the velocity of that move is something we haven't seen in decades, as far as the move from 3.10 or so to 3.25. That really caught the market's attention, right?
Right.
So if rates stabilize, what would you focus on with the bond markets? What would you all look at there?
Well, I think for interest rate, and two things real quick before we talk about the bond market is also just to finish up on Mike's point, which is that, when you're talking about volatility, you go back in history, when you have these 300, 400, 500 point up days, those only occur during corrective periods in the market. Those don't occur when you're in the bull market trend, right? So when the market's trending, you don't get 500 point up days. You get 500 point up days when you just went through a major correction. So the point is that this is typically part and parcel of a corrective process that is not finished yet. In other words, to Mike's point, I think it's very possible we see another rally tomorrow. We're going to get some excitement today from earnings. Everybody's going to be excited. The market was up today. Retail traders are going to get home this afternoon and go, wow, man, I'm missing it. I got to get in tomorrow. And so you potentially get a follow-through day tomorrow. That's good. But I would suspect, and I agree with Mike, that in the next day or two or three, we get up to around 28.50. We're going to wind up having another sell-off day or two. And that's going to really be the telltale sign of where we go to next. In today's Technically Speaking post, I've laid out various pathways, and we're already tracing out one of those pathways today. Where we go to from here will be very important to set us up for the end of the year. To your other point, though, about where we're watching interest rates right now, which is a good question, right? We've been talking about buying bonds here around 3.2%. That's been a good place so far. It reduces risk. Here's the interesting thing. Market was up 500 points today. Bond market didn't move. You would have expected, you would have at least expected to see a big rotation out of the safety of fixed income back into the equity markets if this was indeed the bottom. And I think that tells you that this probably wasn't either. I would look for, and again, where I'm looking for rates there is that ultimately probably within the next several months, we're going to be back down below 3% again. Particularly if economic weakness starts to pick up towards the end of the year, as I suspect it will. Mike?
Yeah, I agree with you. I think if the market can keep marching higher from here, rates will probably maybe head back to that 3.25 type level. But again, I think that then triggers the stock market. So it's the dog chasing its tail kind of thing here. But I agree, over the longer term, I think that we are or have seen the high yield, if not, or pretty close to it.
Right. And, we just started this podcast about 30 minutes ago at 3 o'clock, and the first headline was IBM beats revenues. Now IBM falls on revenue miss. So that's how fast.
That's the way it happens with IBM.
Yeah, and that's how fast it can change. IBM just can't get it together. But they did beat earnings. But as I said, what did I say? I said they were going to beat earnings. They'll miss on revenue.
They always do.
And that's what they did. So
hey, and Lance, here's another one for you. Netflix soars after big subscriber beat, erases second quarter losses, but cuts earnings per share outlook. So it's a double-edged sword for Netflix.
We'll see how that plays out tomorrow. All right. Any closing comments, Richard?
No, I think what, and you have all said this, and I think it's true. You get these big moves in days, even though it makes you feel really great or really lousy. But this is all the signs of a topping process in stocks, isn't it?
Absolutely. No matter, and I laid these pathways out in our article today, is that no matter what we do from here, if we get a huge rally back to the January highs, if we get a rally that fell somewhere between now and the January highs, I can't find a pathway that gets us to all-time highs between now and the end of the year. This looks very much like previous topping processes in the market. And I would suspect going into 2019, with the Fed hiking interest rates, with economic data where it is, that we're likely going to see much slower economic growth in 2019, and that's going to start to weigh on earnings. And the fact that beginning in 2019, we no longer get the tax cut boost. That is, we're going to go back to year-over-year comparisons for earnings. So that tax cut boost goes away. So I think that we may have actually seen the top of this market, period.
Unless we get inflation-adjusted capital gains passed. Come on, guys. That's like cherry on the ice cream.
Or apparently another tax cut and another couple of trillion in deficit spending from this government. So that could, hey,
you never know.
You never know, right? I mean, look, we've already got a country that's running $1 trillion deficit. So throw another trillion on it next year, and who knows what you can get out of the market. Mike, closing thoughts?
No, I agree. And that makes the next few weeks important because we have an election in 2 or 3 weeks. And depending on, it looks like the House could go either way. If the House goes Democratic, odds are any future tax cuts are off the table for the next 2 years. On the other side, if the Republicans continue to control the House and the Senate, who knows? We may get more stimulus to the market.
Yeah. And conspiracy theory for the day, Trump called the Federal Reserve and said, start buying bonds because I need the market up for the midterms. So that's your conspiracy thought for the day. All right. That wraps up the show for the day. We appreciate it as always. Mike, thank you, sir. Richard Rosso, Certified Financial Planner, Clarity Financial, and I'm your host, Lance Roberts. Lance Roberts Podcast right here at realinvestmentadvice.com. Get our latest Technically Speaking posts and more on the website now. Send us your questions and comments. We're all happy to answer your questions for you, no matter what they are. realinvestmentadvice.com. We'll see you tomorrow at 3 right here at the Lance Roberts Show podcast.
Want a longer talk with Lance about your money? Request a personal one-on-one at lancerobertsshow.com.